All right. What's up, everybody? Back live. We'll wait to hopefully some people jump in here. Last live didn't go so well. That was the very first one. So we'll see how this one goes. My screen share didn't work last time, so hopefully it works this time. But with me today, I've got Scott Alejo with Change Home Mortgage, and I kind of wanted to bring him on. He's a lender, and as hopefully more of an expert in what we're kind of seeing and expecting for 2022. There's a lot of speculation that interest rates are going to be going up throughout the year, and we'll see what that'll do to the overall real estate market. And all indications, like I covered last time, it's still projected to be a pretty good year in real estate. But we're going to see some changes with the interest rate. So I wanted to bring him on, talk about that. So before we get too far into that, I've been working with Scott for a number of years. He's a great, fantastic lender, and I'm privileged to be able to have him on my side and on my team to help you guys. And recently, this last year, he was with Commerce Home Mortgage, and they made a change. So they're now Change Home Mortgage, same company, but just a couple of things changed. So I'll let Scott talk about it, but was really exciting, and he'll tell you about it. But it really opened up some of the things that he can do for you guys as far as options and lending goes. So Scott, take it away. I mean, you Change Home Mortgage. What does that mean for you, and what does that mean for the consumer?
Yeah, so thank you very much for having me on your show. Excited to go over a lot today. Hopefully, sound pretty good. I know it's my first time doing a show with you, so we'll see how this goes today. But yeah, no, some great changes coming to Change Mortgage. Yeah, we've been the same company the entire time. All we did was change owners, not change ownership, but change name. The owners had originally purchased a Commerce Mortgage a couple years ago and recently made the change over to Change Mortgage, pun intended, right? But with that change came some additional changes as far as programs and being able to service more borrowers that just can't follow or qualify a traditional program. So we got some more programs that we can offer self-employed borrowers. We have great loans, down payment assistance, FHA, VA, conventional loans. We offer a plethora of programs. It just what makes us unique or different is going to be the additional programs that we're able to offer now. So what I'm going to do is I'm going to share you just a quick overview of some of the programs that we're able to offer now. We call these our change portfolio programs. Just to kind of give you a quick overview of them, we have the program called My Community. Now, the great news about this program is that this program is not going to require any income documentation to qualify. So there's a lot of borrowers today that will never qualify for a traditional loan. Why? They're self-employed, they have a cash money business, their tax returns don't report a lot of net income because of all the expenses they're having to deal with throughout the year. So you're not going to fit the traditional Fannie Mae, Freddie Mac, HUD programs. So a lot of times they're not able to move forward. While we have a program and many programs that will help them still accomplish home ownership, right? So we have our basic and easiest program of all, just requires a larger down payment. Homeowners or self-employed borrowers that have a lot of funds to put down towards a house now have a program that only requires 20% down. Depending on your FICO score, you can actually get away with 15% down. But ultimately, all you need to prove is provide a credit report, show the bank, us Change Mortgage, that you have sufficient money for your down payment and you have sufficient reserves, right? Now, what reserves are is money that won't be physically used for the transaction. We just want to make sure that you have money to fall back on. And depending on your FICO score, that will depend on how many months of reserve you'll need. For someone with as low as a 640 FICO score, 18 months of reserves would be needed. And someone that low as or someone that was as high as a 720 FICO score, only 3 months of reserves are needed. So, trying to kind of recap on this program, all you need is bank statements, or your most recent bank statement, I should say, to prove that you have enough money for the down payment, enough money for the closing costs, enough money for the reserves, and then look at your credit report to ensure that you have the sufficient FICO score needed for the program.
Nice.
Next on that one.
Yeah,
Any
for sure.
questions on that one, Julian?
Yeah, that's definitely going to help a lot of people that maybe didn't have the opportunity to fit into one of the conforming kind of programs for sure.
Yeah. And the great thing about this program, there's no DTI restrictions. What DTI is debt to income, what they call a debt to income ratio, what pretty much what someone makes gross versus what someone spends based on what appears in the credit report, including a mortgage. This option does not even look at that. It's just pretty much coming down to how much assets you have to leverage against in order to purchase a property.
Okay.
Okay. But
Awesome.
let me touch up on a couple more just since we have it up, right?
Sure.
Because there's also a program for investors, and this is what the investor program that we have here right here. Now, very similar to the My Community program, but the difference is this is specifically intended for investors, someone that's looking to buy a rental, right? The guidelines are very, very simple on this one too. All that's required is 15% down and 6 months reserves. Now, the FICO score requirement for this program is higher. You need as low as a 680 FICO score, but it requires a larger down payment. But if you have a 720 FICO score, you can put as little as 15% down. There's no income documentation needed for this program as well. All you need to prove is that you have enough money for the down payment, you have enough money for the closing cost, you have the sufficient FICO score needed for the program, and you have 6 months reserves, meaning you have 6 payments of the mortgage payment set aside after the close of the transaction as pure reserves, as pure emergency money. And you can purchase a home for investors that you want to buy that rental property that you've been wanting to purchase, but you just don't have enough income on paper to qualify, but you can afford it. That program exists for you too. And then we have some additional options for those clients that make a ton of income, but just on tax returns that doesn't show sufficient income, but we can qualify you based on your bank statements as well. So we have some great stuff for self-employed people.
Nice. I'm going to throw you a curveball right now, but
Yes.
if somebody were, let's say, buying a property and maybe it's their first property and they wanted to buy an investment property, right? Um, it's actually easier to qualify for an investment property given that you have the proper funds, right? Than maybe buying a residence that you're going to live in, because you can count a portion of the rental proceeds as the income to help you qualify for the home, right?
So great. You used to be right. That changed recently on Fannie Mae, and then even our guidelines are the same. So in order for you to be eligible, well, let me say it like this. Okay, so traditional financing, in order for you to be allowed to be qualified for rental income, right? Let's just say you want to buy a rental property and you want to use a rental income to help you qualify. You can only use that rental income if you've had a history of receiving rental income for the last 2 years. So it's going to be difficult if you don't own anything now
Gotcha.
receiving that income. So that won't work for a traditional loan. Now, this portfolio programs that we do have, the requirement is that you already own a home, because then we can see that you're paying a mortgage already.
You
So
have
it
history.
won't be, even though it's only 15% down versus a community program that requires 20% down,
Yeah.
we still got to see that you have a history of owning mortgages or you owning real estate. And
Gotcha.
both Fannie Mae, Freddie Mac, and our portfolio programs will require something like that.
Gotcha. Okay. So there's 2022 is here, and we started the program by talking about interest rates,
Yes.
and we have definitely seen a change in the interest rates from December to January. We're almost to the end of January right now as we're recording. It's the
Yeah.
27th of January,
Yeah.
and rates have gone up.
Yes.
So I think well, you know what? Before we get to that, I want to just cover some other good news that I think will help with alleviate some of this interest rate talk, because there's also been some big changes with the loan limits for
Absolutely.
Riverside, San Bernardino County, LA County, Orange County.
Yeah.
We saw some increases. So tell me what kind of increases we had, and then what does that mean for the buyer?
Absolutely. So, loan limits have been increasing for the last several years, right? Which has been nice. What loan limits are pretty much is a set number set by, depending on the county you're from, depending on the average income made, the medium income range in that community or that county is going to determine what the loan limits are. Now, how they determine these, I'm not too familiar with, to be honest with you. I know there's some experts out there that determine what these amounts are. I just know that they're they've been constantly increasing. While we're at the highest they've ever been, right? So I'm putting up a flyer so that the audience can see exactly what we're talking about, right? So um, I have six different counties based on the local area we're from, right? Riverside shows that there's a loan limit now of 562 350. Prior to that, the loan limit was 477 200, I want to say. So it's gone up
Yeah,
quite a
it's
bit, right?
almost $100,000 in a
Yeah.
year. It's incredible.
What this means is prior to this change, people were capped, or homeowners or borrowers were capped to a certain amount. No matter, even if you financially qualified for a higher loan amount, the federal government, the HUD program, would cap you at that specific loan limit. Well, that's gone up, which means it increases your purchase power. Before, you could purchase as high as 494 as your maximum sales price in San Bernardino County and Riverside County, but now we're beyond that. Now I think the number is like closer to 574 now or something like that. We have to do the math, but something in the mid 570s or high 570s, you would now be allowed to get financing on that home. The good news is that conventional followed as well and also increase their loan limits. Um, so specifically for San Bernardino County and Riverside County, this is the maximum amount that you're allowed to borrow to get the lowest interest rate as a conventional loan. There is other options beyond this. You're going to hear the term called jumbo for these specific counties, which means that you're just in a different tier as far as what kind of loans you're able to qualify. Now, jumbo programs are more difficult to get qualified for. This is like the A plus 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 type of loans, meaning really good credit, very low debt to income ratio, a lot of reserves, up to 12 months in reserves. Each jumbo lender has their specific requirements. All that it means is just because you're borrowing so much more money, right? They want to truly ensure that you can afford the mortgage and repay back the loan. But great news is that because the limits have gone up, this opens a lot of doors, especially in these counties, that allows you to still put a very low down payment of 3% or even 5% down. Now, the additional counties that are in the area as well, Orange County, Los Angeles County, they have the same exact loan limits for FHA and conventional, which means that you can borrow as high as 970,000 for a home. San Diego County is a little bit lower of 879, and then Ventura County is right at 851.
Nice. Yeah, so that's been pretty big. I mean, with house prices over 2021, the increase, that we saw, it was getting, to where a lot of homes were kind of becoming out of reach for a lot of buyers in San Bernardino, especially in Riverside.
Mhm.
So that's fantastic. That's gonna keep that market flowing, and we'll see what it does with demand. Speaking of demand, so interest rates. Now we're going to get to the interest rates. So they've gone up. Tell me what's happened with the interest rates since January.
Yeah, so if you want to share my screen again, what I'm sharing with you on the screen right now, excuse me, is pretty much a mortgage-backed security chart, right? Like it's pretty much showing you what mortgage-backed securities are valued and being sold for and purchased for, just like stocks, right? And ultimately, the lower the value of that mortgage-backed security, the higher the interest rate that the bank would have to charge because they still got to make their profits, right? So the higher the yield spread, the more money they make, the lower the interest rates they're able to offer. The lower the yield spread, the higher the interest rates, right? So since the beginning of the year, you can see right here, this is January 3rd. This is the end of last year, December 31st. We kind of stayed right above this Fibonacci level for the most part, right? And then we kind of took off since the beginning of the year, right? We're kind of in this area. What this does right here, because the yield spread has decreased for the banks, it forces them to higher the interest rates. That change right there, change rates right between like 3/8 to to make it simpler, right, 0.375 increase to the rate as high as 0.875 interest to the rate. It all depends on the program, your FICO score, the down payment, of course, all those things matter. But that adjustment right there, that little shift right there caused rates to, on average, to increase by 0.5%. But I want to show you in a further back picture, like what has happened since 2020, because in 2020, this is where we kind of pretty much, not pretty much, we We had the lowest rates of all time right here. As you can see, since this point here in 2020, we have only been going down here, which means rates since 2020 have been climbing, and have been increasing. And that's why you're seeing rates going up, right? Um, and the biggest driving factor as to why we're seeing rates go up is has to do with inflation. I know a lot of you have seen gas prices, eggs, milk, everything's kind of gone up in price, right?
Bacon.
Yeah, bacon, exactly. So that's why we're seeing the climbing of rates. But as you can see, if we go back to 2019, I wonder if I can even go further back than that. Let me see if I'm able to get even further back than that. You can still see back in 2019, rates were still higher than where they are today. So I know we get spoiled a little bit and seeing the rates in the twos, right? And we want the twos again, but if we look at the history of interest rates, and even as early as 2019, we're still at a better place than where we were, a few years ago. And in 2019, we were even happy with what rates were doing then, because we're like, oh my God, it's the lowest we've seen rates. And then we got this crazy curveball of COVID, and then we definitely hit the ceiling when it comes to interest rates.
Yeah, for sure. I mean, there's so we're getting close, depending on programs and things like that, to the four mark, and what are you hearing as far as what we could expect moving forward to the rest of the year? I mean, I think you and I had talked about it in the past where, they had moved some stuff. I think it was right before COVID, right? We had that tick up in interest rates. You just showed that dip right there, on that screen, but then they changed it real quick. I mean, so I have a feeling in the way that they have operated in the past that they could make some adjustments and then it could go back and then go back further the other way and then come back a little bit and kind of go back and forth and kind of fluctuate. But ultimately, they're talking that by the end of the year, overall from 2021 to the end of 2022, that we will see an overall increase in interest
Yeah,
rates.
there's a lot of factors that come into play. Honestly, it's still a little early. We'll see how far in how where we go end up, how as far as inflation, how high we go, right? Because now they're talking about 7% in inflation, which is crazy, right? There's still a lot of factors. I know that come March or this year, the federal government talked about hacking rates 3 times this year, right? Now that won't specifically affect mortgage-backed securities. I mean, it will have a play in it. It does have a factor in it, right? But typically, the plan in regards to raising the federal rate hikes, right, that are coming, that has to do with countering inflation. That's supposed to help um, stop inflation as opposed to causing
Theoretically.
it to go up, right? Theoretically, exactly. Still a lot to go. There's a lot left until what happens between now and March, right? So we're not sure yet, but it's a pretty general, like in the industry we all have an idea that yeah, rates will continue to climb somewhere between another quarter to possibly a point, from between now to the next 6 months to the possible year. It's hard to tell. Will they be up and down moments? Absolutely, right? If you go back to the screen, I mean, we can go far as back as um what let's see, what year, how far back does this go? We're going back as far as 2017. So you can see that even as far back as 2017, rates were better in 2017 than they were in 2018, right? Like we had this dip from 2017 to 2018. So it this is more just to give you an idea that you're going to always have rates constantly going up and down. There's not really a set number. um, so it's just a matter of how soon you purchase a property, and and when you lock your interest rate.
Yeah. So let's talk about that. I mean, so there's definitely a lot of demand for the buyers right now. I mean, it's a
Mhm.
big seller's market, and really what's causing this seller's market, and I've talked about it in the past, is the lack of inventory. To give context, pre 2007, when the crash happened, we had almost 4 million, or we had about 4 million homes on the market nationwide,
Mhm.
and over this last year, and even getting lower into 2022, we've been hovering around 1 million homes. There's a lot of building that's going on, new construction, because over the last decade they've built less homes than they've built over the past 40 years before that. So we've really had a lack of new build inventory to help alleviate some of that. We've got a lot of low interest rates, people that are locked into these low interest rates, maybe not wanting to sell or do anything because they've got that low interest rate. Where are they going to go? Things like that. But the reality is, we still have a lot of, buyers that are looking to buy. And, even at the current interest rates, let's just call it 3.8 or somewhere around there, plus or minus, if that was the case, that's still historically a really good interest rate, right?
Absolutely.
So, so let's just talk maybe like if somebody were to get a house today, let's say it's 450,000, 3.8% interest rate. And, let's say over the next year we get, another 0.5%, or let's just call it a 1%, 1 point increase by the end of 2021 or 2022. What would that mean as far as a monthly payment for somebody looking to buy something, around that $450,000 range?
So roughly, right, we're just going to use this little cheat sheet of ours just to kind of give you a rough idea, right? Let's just, like you said, the rate could be lower, the rate could be higher. Let's just use 3.875 as our example. So we can see here at a sales price of 450 with the 3.5% down as an FHA loan. We'll use that example for now, right? Here's a purchase price, loan amount, down payment, principal and interest, taxes, insurance, mortgage insurance. That payment comes out to $2,977.29. So let's just say rates went up by a point, like we mentioned, right? So that now we change that to 4 point. Let me write this down. 2,977 is what we're going to explain. We're going to compare it to, right? So 2,977. Now we put 4.875. If we're waiting more time to purchase, now look at that payment. It increases by about $300 almost, right?
Mm-hmm.
So that means that if you're on a budget and you want to still keep your payment below $3,000, it's going to pretty much shave off about somewhere between 30 grand to 50 grand off the sales price. It's all going to depend on your purchase range, right? But look at that. It's pretty much you to get the same, and this payment's still more than, technically speaking, than what the 2,977 was, right? But I mean, it's going to give you an idea, right, of what that is. So it's you're shaving off somewhere between 35 grand, 40 grand, 45 grand, depending on your budget, right? Which is a pretty big difference. As far as what like your purchasing power would be, you would have to make a decision. Do we either put a larger down payment, or are we okay just having a higher monthly payment?
Yeah. Is there, I know in the past we had talked about, I mean, is there a way, if somebody does have, significant reserves or a decent amount of reserves, is there a way that they can buy down a rate? Like, let's say they want to stay in this house for a long time, right?
Yeah.
So typically if you're in a house longer, long term, having a lower interest rate over the length of the loan would definitely save you a lot more money than a little bit of money up front. So is there still the possibility to maybe pay a little extra up front to get a better rate?
Yeah, definitely it's an option. It's a double-edged sword though, because I understand payment matters, right? Especially first-time home buyers, it's that fear of committing to a specific payment, and now the pressure's on because you're kind of feeling like no matter what, I gotta make that payment, right? But if you really think about it, rent's no different. I mean, I understand we have the luxury of being able to walk away from the rental property and go to somewhere else. I mean, it's no different than selling, right? Where was I going with that? No, my mind.
The difference with the down payment, buying it down versus sticking with that payment.
So buying down the rate, it's tricky because it can cost you quite a bit of a difference in the payment by $100, $150, $50, right? But you gotta be sure that this is a home that you're gonna grow old in. Meaning, if you pay, let's just call it an extra 8 grand to lower your rate by 0.5%, as an example, if you refinance or sell that property in the first 7 to 10, 5 to 7 years, that additional money that you spent to lower the rate kind of is you're throwing it away because of the fact that you spent extra to lower your payment, and now you're going to turn around and sell it. So I would only recommend buying down a rate at a substantial amount, like a huge amount, if you're like doing like a 20-year loan, a 15-year loan, like you're going to grow old in this house, like you've lived in this home for quite a bit of time, and you're not going anywhere, because the odds are against you that you are actually going to keep this home longer than 7 to 10 years, especially when it's your first home. Because what? Life happens, right? We get
Yep.
married, we have kids, we change jobs, we move locations and jobs. So there's a lot of factors against you as to why I wouldn't necessarily go that route. But what I would use your first home as a vehicle to allow you to purchase the next home, right? Gain that equity on that house, make your mortgage payment, don't throw it away in rent, right? So that way when you are in a position to potentially refinance to either lower the payment, you can also look at the idea of selling the property and using the equity gained on that home as a large down payment for the home that you are really were looking for originally.
100%. 100%.
Yeah.
Okay.
Now,
Um,
Julian, I would like to add something to this, right? Like
sure.
a lot of buyers right now in today's market, right? What are you hearing from people that want to buy? What are a lot of these home buyers telling you as to why they don't want to purchase, or what are they waiting for?
Yeah, I mean, most of the buyers that I'm talking to, one of the things that they're really scared about, like, are we at the top of the market? I don't want to buy at the top. What if it goes down to next year or the year after? Like, buying it now, I think I'd rather wait for the market to shift. Kind of
Absolutely.
what
Right.
most people are talking about right now.
So let's give some perspective to those people, right? Let's see
Yeah.
what we're really waiting for, right? Let's see, is it really worth waiting for the market to crash, right? Because we don't even know how much that crash is going to be, right? But is it worth waiting for the market to crash? So I'm going to just use a blank sheet for now, just to kind of help visualize. Now, does it look distorted on your side? Is it?
It does look a little
Yeah.
distorted. Let me
All right.
go back and then come back. It should be
All right,
straight almost.
let's just do the best we can. And this is or your second one, but my first one. So I'm sure we'll get this one done. But I'm going to use you as an example, Julian, right?
Yep.
So let's just say, for example, now this is going to specifically apply for people that pay rent, right? Like if you live with mom and dad, it's not going to apply so much because if you're willing to live with mom and dad for another 3 years, 4 years, and hey, kudos to you, right? Or if you already own a home now and you're happy with where you live, kudos to you. But this is going to go for a lot of people that pay rent today, right? Because I know I'm
Yep.
pretty sure rent's expensive, right? So
And
let's
going up.
we were purchasing a house in Rancho Cucamonga and we were renting a house in Rancho Cucamonga for a 3 bedroom, 2 bath house. What would you say would be the amount that I would be paying in rent on a monthly basis if I wanted to rent now?
Uh, Approximately 3,000, 3,200 is probably somewhere around there. Just call it
32
3,000.
3000. Okay, so $3,000 a month in rent, right? That's what my comparison would be, right? Compared to if I purchased a home in Rancho Cucamonga today, what would be my average sales price a day?
You're getting, let's just say 575. You could
570.
probably
Okay.
600.
Which we know 575 means that I'm most likely going to have a higher mortgage payment than 3,000. I get it, right? Depending on the down payment you put. But we're going to use this example to find out, is it worth waiting for the crash, right? So when we hit the peak of the market right back in 2008 and then we started seeing the dip in the market, do you recall like about roughly how long that took until we hit the approximate floor? Was that like overnight? Did that take a couple years? That
Took
how
a couple years.
a couple years, right? We would say somewhere between 2 to 4 years before we hit the bottom, right?
Right.
So if we were to wait 2 years, right, for the market to crash, right, that means in 2 years we're gonna spend $72,000 in rent for the next 2 years. That's how much rent will be used no matter what.
Yep.
And if we said, okay, let's be a little more conservative. Let's just say it took 3 years, right? A 3 year period now would be $108,000. So we know that no matter what we do, if we continue to pay rent as we wait for the market to crash, this is how much we are going to spend by paying rent, right?
Yes.
Now, Julie, let me ask you, when the market did dip, do you have like a percentage? What was the average dip in the market back from 2008 all the way to rock bottom? What kind of percentage are we talking? Was it
I
20%, 30%, 50%?
I think it was closer to 30, 40%, right?
30, 40%, right? Okay. And then would you say that based on what we know today and based on what we can tell, based on what the market's doing, would you expect there to be the same type of dip this time around?
No, and I'll tell you that over the last, I think we're at 7 recessions counting COVID, right? Over the last 30, 40 years, only two of those recessions out of those seven, actually home prices went down from the start to finish, 2008 being one of them. So 5 out of 7 times the correction in the market was minimal. And from when they decided it was a recession till when we got out of it, prices had increased. So
Okay. So let's just say there is a correction this time, right? And we say correction when what's really correction mean, because it just means it's a new norm, right? The new medium price range, right? So what
right.
would you say percentage wise on an aggressive percentage you would imagine from here on out, like for the next 2 to 3 years, what kind of dip would you, if there was one, right? What could you see that be look like?
Given everything that I know about the market right now, I'd be hard pressed to see it go over 15% personally.
50%. All right. So I'm going to use your 15% as the number, right? So that means if we bought a house at 575, we're about to lose $86,000 in value. In value. And if we want to take it to the next step and say it's 20% dip, let me call it depreciation, right? Let's just call it, right? We're talking about 115,000, right? So you're probably looking at this and thinking like, wait, Scott, so you're telling me if I wait 3 years, right? Worst case scenario, I spend $108,000 versus losing 155,000 here, right?
Mm-hmm.
Or if I wait the 2 years, worst case, I spend 72 grand, but I only lose 86,000. So it's a win-win, right? Like it's like, which I guess looking at that, which one is the winner, Julian? Would you say continue paying rent, or which one is a higher amount? Which one will I lose more money on?
Well, I know the answer, but I mean, on paper, it looks like you would lose on you'd lose more renting.
Yes, no, I guess in this case,
No,
right, I would lose more in buying a house, right, because the number's higher, right? It's
right.
86,000 versus 72,000, and it's
72. Yeah, yeah, yeah.
155,000
Yep, yep.
versus 108,000, right? But I'm
Right,
gonna
right.
share with you as to why they actually don't hold the same value. I understand, I get why it could look like it could be deceiving that I'm saving money, but let's be honest about this, right? Because you see, this right here, this money lost in value, where does that money come from? Where are we losing money from?
We're losing money from the value, what the perceived value of the home is
The perceived value of the home at that moment, right?
at that moment. Yeah,
Yes. And then when it comes to rent, where are we losing this money from?
out of our bank account.
Out of your bank account, right? So this one's physically coming out of your pocket, but will this one physically come out of your pocket? Because as we know, mortgage loans today, right, or most loans, right, there's still variable options out there, but for the most part, I would say 9 out of 10 borrowers today are getting a 30-year fixed principal interest,
Correct.
tax, and insurance payment, right? So that means
Right.
this whole entire time as years pass, the balances are going down, right? So if I said your house, like a vehicle, right? Your car's no longer worth 50 grand, it's only worth 30 grand. Did you physically lose 20 grand?
No.
No, right? So we don't physically lose anything based on an opinion at that time. But what do we know? Let's just say it does hit 20% dip, right? What do we know about real estate when we hit a floor? When the values hit so far down that we reach a floor, what typically happens next?
It goes back up.
They go back up. So that means you're telling me that with values going back up, this money that I lost on paper of 155,000 or $86,000, I would potentially see again.
You should. Yes.
Correct. Now, if I spend $108,000 to the landlord, will the landlord tell me in 3 years, you know what, Julian, you've been the greatest tenant of all time. I want to give you back your money. Will that happen?
Not in a million years.
Not in a million. So we're waiting for the market to drop by $155,000, which potentially rates will be higher then, because it's kind of safe to say that all charts are pointing in that direction, right? That's not to say that they're going to get to 8, 10, 12. We don't know. But it's safe to say that they're not going to be in the fours anymore. They're most likely be in the high fours to low fives, maybe mid fives. I don't know if sixes is going to be in the realm of possibility. Who knows? But there'll be a point to a point and a half higher from this point, right? So that means while we're waiting for the values to dip, we're already spending $108,000. The same money we plan on saving on a house, we're spending on rent. So if you can afford the mortgage, and if the house is in the area you're looking for, you can see yourself living in the house. This is a prime example as to why purchasing is the absolute thing you should try to do, right? Is because you're going to lose money by continuing to pay rent, and money that you'll never see, along with the benefits that come with owning a mortgage and having a mortgage tax write off for your taxes. There's just a lot of positive factors that help you with owning a home for the future, then continue to paying rent. And we're not even counting, Julian, because I'm sure that you don't own a home now, right? Saying that you're the tenant. That means for the last, what, 2, 3, 4, 5 years, 6 years, 7 years, you've already been paying rent, which means if we use that same $3,000 factor and we go back 3 years, that means you've already spent $108,000, which means you're on track to spend $216,000 to wait for the crash.
Yeah. And you're just, I mean, the example you just gave is literally dollars for dollars, right? You're looking at the value of the house versus the money you're putting out for rent. You're going to be paying that monthly mortgage or rent regardless. And if you own the house, that money is going towards your principal.
Absolutely.
Granted, in the beginning of the loan, it's less than it is later, but you're still gaining the benefit of that money going towards your paying off your loan debt, right?
Absolutely.
So that would typically increase or decrease the money out of pocket overall versus the renting anyways.
Yep.
So it makes that scenario you just put out there even better when you take that into consideration.
Absolutely. And that's hopeful, right? And then the other thing too, the factor is for a lot of buyers, they're hoping to see this type of dip, which it'd be nice, right? For a lot of first time home buyers, a lot of buyers out there. But I know experts have been wrong before. It's just it's tough, right? We're definitely hoping for a lot.
Yeah, and I think that to just take in your scenario one step further, waiting that 3 years you've been paying, I think you kind of covered it, but like you said, in 3 years, when the prices, if they price dip and they go down 15-20%, the interest rate at that time is going to be from all indications higher than it is today anyways.
Yeah.
So yeah, it's a win-win. I mean, it makes sense when you break it out that way. And thinking about what's going to be happening in the future, that now is still a good time to be on the buy side, even though there is a lot of competition in the market. If you can find something.
And if we go back to that original comparison that you brought up, right? Let's just say the rates are different by a point. I mean, you're losing about 40 grand in sales price purchasing power. So let's just say the property dropped by 50 grand, you're going to be right at the same payment that you were trying to avoid having now, So it's like, wait a minute. So you're telling me that I'm going to buy a lower sales price and still have relatively a similar payment at a higher purchase price?
Right.
What am I doing?
Yeah. Exactly.
Look, there's a lot of people out there today, probably watching today, they're saying wait, Scott, I get it. It sounds great on paper. It's just, it's hard. I mean, there's a lot of money being needed for a down payment. I don't even know where to start. Look, this is where we come in as experts. There's down payment assistance programs. There's ways to increase your your FICO score. Use us, let us guide you to get there. It may take a 2-year period. It may take a 3-year period. We have had clients in the past that started the process 7 years ago. From here till now, they've used a down payment assistance program. It took them 3 years to fix their credit. They refinanced after this point. They're sitting on equity today. You just got to get the ball rolling. Find out what it's going to take specifically for you, so that way you know exactly what it takes to become a homeowner. And that's addressing your credit, the income, and the assets. Once we get those 3 pillars addressed and give you the guidance that we need to get you there, it's just a matter of following it. And then hopefully, right, when you're ready, prices are at a range that you can afford, right? I know we can't control that part. I know it sounds simple, but we don't want to make it we don't want to look over it like it's not difficult. We understand it's a difficult thing. It's just, we just got to make sure that you have the right information in front of you so that you guys can start working towards getting there.
Yeah. I mean, and I find it to be a lot, to be pretty consistent, where I'm talking to folks that, definitely express an interest in home ownership, right? They want to buy something. They are skeptical about everything that we just talked about. But there's this I think there's a what's the word I'm looking for? Like a uh they're hesitant to talk to somebody like yourself, like a lender or even a realtor, right? Because they feel like there's some sort of a pressure or an obligation to do something rather than more of a informational kind of a setting up a roadmap. I mean, because that's what we do, right? And that's why I do partner with you and I work with you, and because of the way that you work, it's very similar to me, right? I'm not here to pressure somebody into doing something that they're not ready to do, but I am here to provide as much value and information that I can to you so that you can have all of the building blocks, all of the knowledge that you need, whether it's now, a year, 2 years, 5 years from now, 10 years. Like you have the knowledge and the game plan in place to take those steps to get
Absolutely.
and reach the goals that you want, right? So I
Absolutely.
think that that's important to put out there, that there is no obligation when you talk to somebody like Scott. There is no obligation to do anything right now, but it's very critical that you get the information that you actually need to make the best decision, right? Is now the
Absolutely.
time for you? Is it in several years from now? And what can you do to be ready?
Absolutely. Yeah, and like, and
So
some things that I know that are out there. A lot of times people think they need to put 20% down. Guys, you don't have to put 20% down. 20% down helps you avoid paying mortgage insurance. That's the biggest, hugest factor as to why you hear 20% down out there. And for those that don't know what mortgage insurance is, also known as PMI, this is mortgage insurance only for the bank, to protect the bank in case you were to lose a property via foreclosure, short sale, or bankruptcy. A lot of times, we're like, people are like, I just want to avoid it. I get it, but look, just get your foot in the door, get your first home, get past it. Eventually, you're going to have enough equity to be able to put a larger down payment on the next house that you do purchase to avoid mortgage insurance. But if you don't do that, some of us, we can't save 80 grand, 100 grand in 1 year, 2 years, or 3 years. That's a lot of money to save. But you can use owning the mortgage, paying down the principal, using the mortgage tax write-off on your taxes, you letting time pass. Because what would you say, Julian, is an average appreciation per year? What's that number? Do you know?
I mean, historically, it's been around 5 to 6%. Obviously, this last year has kind of thrown a wrench in that. But let's just say, I did a reel the other day, which was talking about buying a new home with 20%, with $20,000, right? And let's say you took that same $20,000 and you put it in the stock market, and you made an 8% return. Let's just call it 8% on 20,000. You're going to make $1,600, right? But if you took that same $20,000 and put it into a $500,000 house, and that $500,000 house over the next year increased 8%, that's $40,000. So you double your money
Hmm.
in 1 year. So that's
Absolutely.
the leverage. That's what you're talking about, getting into that first home, allowing your smaller down payment to grow over time, because real estate typically goes up, right? And it multiplies in a way that you can't necessarily get with regular institutional or with like stock market investing and things like that over the long term, right? It's harder to do.
Now let me ask you a question, Julian. Right? So you're saying 5 to 6%. Let's just take it 3%, right? So that means, let's just say 5 years pass. That means in 5 years you gain 15%, right? Which means that what, another 3 years from now you're about a 20% equity. Now let me ask you, if I, as a primary residence homeowner, right, I'm in a position now where I have 20% equity. I'm either deciding, do I want to refinance to eliminate the mortgage insurance that I have in my current house now? Or, Julian, can you help me sell my property and purchase the next property? Will I be paying taxes on the money that I make from selling the property, with this being my
uh,
primary residence?
no. So if you're your primary residence, right, and you've lived in it 2 out of the last 5 years, you can sell that property. And if you're married, so if you're single, you can have a $250,000 uh, return without having to pay capital gains. If you're married, you double that, because it's for each spouse, right? So it's up to $500,000 in equity you could potentially have, sell your home, and pay no taxes on that money, and roll that into the next house.
Phenomenal, right? So it's just, again, another factor. And again, guys, we get it. I mean, it's hard, right? It's easier said than done. but you got to start at the first step is just getting pre-qualified. Take the band-aid off the wound, right? Find out exactly where you are, what it's going to take, and get guided in that direction.
Yeah, for sure, for sure. So I think we've taken up a lot of time. We're at 45 minutes, so
Oh, wow.
I think we covered the whole gamut. Like, it went pretty
sure.
quick, but
Yeah.
I think we covered a lot. So if you guys have any questions, I'll put Scott's info in the comments over here, so you can reach out to him if you have any questions. And I appreciate you guys watching. Make sure you like it. If you know somebody that's in the market to buy or sell, send them this video so they can get a understanding of where things are and what some of their options are. And hopefully we'll see you next week with another episode of the show.
Right on.
Well, we'll definitely have Scott on when we get some more updates in the lending side of things. Absolutely. And with interest rates and all that kind of throughout the year.
I'm
so
sure in the future we'll have some more details and more broken down specifics. I know we had a general idea of it. And if you guys have any questions like, hey, what about this scenario? What about, I've heard about this program, please email us, text us, send us some information, and we'll cover it. Whatever ideas
put it in the comments
you want to cover, add it to the comments, and we'll create a video for it.
For sure. All right, Scott, I appreciate the time, and we'll see you soon.
Sounds good. Have a good night.
All right, you too.